Let's talk about Silicon Valley Bank. So imagine Silicon Valley Bank has a bunch of money that they're lending out, which is what they do. They're specialized in bridge loans for venture capital deals. And they put out, let's say, $1 billion. That means they've got to have $3 billion in reserves. Let's say $1 billion of that is in real estate, safe as kittens. Let's say another $1 billion of that is in cash. Well, the other $1 billion was in bonds. Now, what has happened to bonds over the last year? Just like I told you, interest rates go up. What happened to bonds? They go down. So in other words, they didn't have enough reserves, and all of a sudden the regulators came in and said, you can't loan any more money, and you can only give out this much money to your depositors. What happened? The depositors did an old-fashioned run on the bank. In other words, they came in and tried to get all their money out. But at the end of the day, it wasn't so much a bank failure, it was a failure to monitor their reserves, and you can thank the good old US government for putting too much stimulus in, causing interest rates to go up and causing this inflation. And that's the moral of that story. More to come, because I'm sure that's not the first bank that this is going to happen to.